We are live. We just took a 305% profit on Boyle, which is a natural gas play, and prepared to do a new trade alert next week. Right now, the Boyle is in cash, and we almost got the very, very top on that one. It's down 16% today. Depending on what happens Monday with the war, we can decide whether we want to re-enter Boyle or look at some alternatives. And again, Monday is a big anniversary for Russia, so we'll see how that plays out. I really don't expect the war to de-escalate anytime, so Boyle's still potentially in play, but it was at a extreme pricing, so we took those profits off the table. Our top selling advisory is now up 46% total return year to date for 2022. And this same high risk growth portfolio strategy returned 233% in 2021. That's enough to turn every $10,000 invested into $33,000. Today's presentation is our view on how to get rich in 2022. And boy, are people having a really bad year in markets. We're going to recommend you buy these 4 stocks now before it's too late. And the reality is it's 3 you can put into your portfolio today. The 4th, wait for next week. Now, pick one is a play that energy prices will go higher and higher and higher as long as there is a conflict in Europe. And if you're wondering why there's a conflict in Europe, this map does a very good job at illustrating that. Red is NATO in 1990, and then we can see what's happened over the last 30 years. So this has become a critical issue, and looks like there's really no end in sight. Looks like most likely Russia's going to go all in to take over parts of Ukraine and declare some sort of victory. But meanwhile, NATO is not pushing for diplomacy whatsoever, just piling in money and coming up with new nicknames. We're in it to win it. Meanwhile, the ruble is trading at an, I think it's a 1-year high now. So, so far, this has been very interesting start to the year. So yeah, I'm considering re-entering this exact position next week, maybe Monday or Tuesday, but stay put. A lot of people want to front run the trade alerts and do things that are not in the trading plan. You'll notice if you followed me, I'm pretty much a turtle, very slow to make decisions, just very, very patient type of investor with a long-term outlook. So don't buy it today, hang on, we'll give you the update next week and make the call at the right time. Because there's some things going on that are surprising me, which I did not predict accurately, which is primarily the bond market collapse. Now, if you know, I was predicting that interest rates would get to this level, but I was predicting it would take 2 years. It has transpired in 4 months. And now I'm in the expectation that interest rates are about to fall, and that we're going to have some pretty big deflationary forces driving this. One of which is kind of a mixed bag. It's China's lockdowns, as well as we've just got massive financial tightening. We've got energy prices at very high levels. We've got interest rates at very tight levels. And so this all combined is almost certainly going to lead to a slowdown in the economy. Here's all the ships that are stuck out of China. So it just gives you a feel for how shut down the country is. This is just mind-boggling. Now it's going to create consumer inflation for the US and disrupt supply chains for key companies like Amazon and Apple, just to name a few. So it's a mixed bag on the deflationary and inflationary impulse of what China's doing with these massive lockdowns across the country. So pick 3 made a 20,000% return in its first 5 years. And I believe it will easily go up another 400% in the next 3 years. Now, this one's been painful to hold since December, highly correlated to the NASDAQ, and it is Ethereum. To really put it into simple terms, we think of Ethereum as the decentralized version of Microsoft in terms of designing an operating system to develop applications on. And this is our favorite tech growth play for our high risk portfolio. Now, let's just look at the history of volatility for Bitcoin. And what's critical is that as the market cap has grown for Bitcoin, the volatility has reduced over time. And so when we look at the grand scheme of things, this is not totally out of the unordinary to have to sit through a painful period like this with crypto. Now, if you've been through some of these bear markets, you've been in the game, you know how long they can last and how agonizing they can be on your portfolio value. But long term, really ask yourself this: do you believe governments are going to spend more money than they make and essentially deflate the value of their currencies? Or do you think governments globally are going to be headed towards a world of austerity, where the government can only spend its tax receipts? So absolutely, we know the people running the world are hell-bent on driving interest rates to negative territory and massively expanding credit. And so this is our favorite long-term growth asset for the high-risk portfolio, Ethereum. In our safe growth strategy, we're doing the less volatile alternative to Ethereum, the Bitcoin play. Now, is the cryptocurrency space highly correlated to the stock market, specifically the tech sector? Over the last 2 years, absolutely yes. However, if we go back before the quantitative easing went into hyperdrive, you can see it was a little less correlated over the previous decade. So at this point, we currently look at it as a leveraged NASDAQ play for good reason. And as this asset class grows, perhaps it can become less and less correlated. But right now, when we look at the value of financial assets in the $300 trillion range, and cryptocurrencies are under 2 trillion, we can understand why it's really just trading like a NASDAQ penny stock at this point, because it has a lot of growth ahead. Okay, pick 4 protects your account against a stock market crash and made a 1,000% gain in 2020. Here's a look at that. UVXY is the ticker. That one's obviously done well for us over the last 42 hours, down slightly today. But in general, we've had another spike in UVXY. So we'll make some decisions if we can trim that down next week or let it ride. Really, what I want to see is the damn bond market stop this descent. That's going to continue to be a big problem and has again surprised really every investor I know with this severe drop in the bond markets. We'll cover that in a minute. But we can see there's very low liquidity in markets. And so perhaps this is about to reverse and have some liquidity coming through. Because right now, just tiny amounts of trading volume are making the prices of stocks jump up or down at extreme levels. And so let's take a look at the current trade alert recommendation for a $10,000 portfolio. And again, if you have 20,000, double it, 30,000, triple it. If you do upgrade, you'll get access to our software in the membership area where you can punch in a specific amount of money and let that calculate exactly how many shares to purchase. And again, we do offer 2 strategies: safe growth. It's the Jeffrey Gundlach, Ray Dalio, extremely diversified strategy. And then we have the high risk, which is much more aggressive, targeting very specific assets that have extreme potential return. So step 1, buy your crash insurance, 62 shares of UVXY. It is a bit expensive today, but the key is you buy all the assets at once. And then when one goes up, it's designed for another to go down so that they can go up over time. So UVXY, here's a chart. Today we are at 17.53, so it's jumped up another 70 cents. We've seen this fly up to 22 earlier in the year, crash back down to 12 and jump back up. Step 2, go long treasuries. A lot of reasons why we believe interest rates will fall uh, over the next 2 years, and perhaps my estimate of how long the bond market crash would take could also be in the wrong time frame for how fast Treasury yields could fall. So this perhaps uh, rallies really hard and really fast once we get the right conditions, which we'll talk about in this presentation. But 132 shares of TMF were above the channel. That's been very predictive of lower yields. The rate of change of yields is historical. The 4-month decline in bonds has never happened in this magnitude ever in history. So we are highly recommending to buy the dip on treasuries. This is TMF. It's at 12.30 today. So it's down another $1.30 from this chart. And this is at a very, very dangerous level. This needs to be updated, but the duration of the crash and the magnitude is historical. So if you're looking for blood on the streets to invest, with the old Rothschild saying, you certainly have it in the bond market. Step 3, buy 155 shares of ETHE. That's the Grayscale Trust, give you exposure to Ethereum. Here's that chart. Let's see, today we've got ETHE at 1950. So while the VIX is expensive, the bonds in Ethereum are relatively cheap today. And again, that's what we're going to recommend you buy all three. Now, going back to what makes us bullish on cryptocurrencies in the long run, the main question is, will governments spend money they don't have? And absolutely. So right now we have Japan already printing like crazy to protect their bond market. It's called yield curve control. It's causing the yen to devalue about 20% in less than just a few months. So just a remarkable move in the yen. China is now printing to protect their real estate market, and now they're going to have to subsidize a closed down economy. So we can see their currency is now devaluing. So what this is making prices look like, they're not rising because we've got the value of the dollar going up. That's making our crypto positions look weak. But here's what I think. The second energy prices fall, so will the dollar. And that's going to make our cryptocurrencies go up. This is a very extreme move in the dollar. That is a headwind against the valuation of cryptocurrencies. So with bond yields rising, it's driving lots of money into US products, especially our bond market. But what's going to happen if yields fall? Likely the dollar falls too. That's where we're going to expect to hit that big gain in the cryptocurrency space. Now, in our safe growth strategy, that's also when we're going to expect emerging markets to finally outperform. Now, step 4, wait on this one. We may be back into BOIL next week. I'm not 100% sure what I'm going to do yet. We sold the BOIL position this week, 305% gain. Luckily, it's pulled back. It's still in play. The reason why we're long BOIL has absolutely not changed. It was just too good of a return to turn down. And there's a key event Monday where we need to see what's going to be the direction of the wars. Is Russia going to try to claim some sort of victory and ease off of this and negotiate a rollback in sanctions, or are they going to go full blast? And so at this point, it does not seem to look good for diplomacy. So we will cover that in more detail. But yeah, we sold BOIL around 114, 115. I think it went up as high as 122, and now it's fallen back down to 105. This thing is super volatile. Normally, natural gas is trading about $2. It's been trading at $8. So you got to realize, even though it looks like an unstoppable trade that just prints money, the reality is it could fall fast and furiously if there was some sort of resolution or diplomacy in the works. And again, at this point, it just doesn't seem like either side has any interest in that. In fact, it looks like the U.S. Primarily wants to beat Russia down to economically as the primary goal, and perhaps a longer-term strategy to try to somewhat slow down China's rise. So it looks like that maybe is perhaps the big picture war strategy here, which is playing out. Okay, so if we look at the table, you can see we have two sections. Up top, the defense; down below, the offense. In red, we have our defensive plays, typically deflationary. We've got UVXY for stock crash, 62 shares. We got treasuries for a slowdown in the global economy. And we're seeing this in the import exports out of China. We're also seeing this start to play out with the consumer having to use lots of credit and the savings rate falling. And we're also obviously not having more stimulus checks sent out, which was driving a lot of the inflationary impulse. Now, to counteract that, we've got supply chain issues out the gazoo. So food and energy are being extremely disrupted by Russia, Ukraine, and now China, with its self-imposed lockdowns, is also hurting the supply chain. So that's all inflationary. But how long can that last? That's the big question. So on the offensive side, we're long Ethereum and BOIL. One goes up typically if interest rates are rising, which would be BOIL. The other typically goes up if interest rates are falling, and that would be Ethereum. So 155 shares of Ethereum, and then hold back on BOIL. I'm going to give the trade alert next week. It could very well be to just jump right back into BOIL unless there's some sort of significant improvement in diplomacy, which again, so far just does not seem to be even being spoken about by anyone at this point. Now, the bond market's on the verge of crashing the stock market. We've been warning that that could happen. And so Wednesday, everything goes limit up after the Fed speech. And then Thursday, Friday, we've been seeing some extreme selling. So it looks like the crash in the bond market has created some margin calls because we're not seeing that volatility in the energy prices now. The rate of change on energy prices has calmed down. So I think the damage from that in terms of creating significant losses that could create cascading selling effects is over in that front. Now we're dealing with the ramification of these interest rates going so high so fast. And again, the TLT at 120 was a red a line in the sand. We're now at 113.50, and I'm actually impressed that we don't have a full-bore crisis at hand yet. So we're watching this carefully, but the TLT becomes more and more attractive. But of course, we like TMF for the leverage. Yields and energy prices cannot remain at this level without disrupting demand. Here's a look at oil. And again, it's been coiling up here. What's the next move? Again, it's all going to be catalyst driven based on the war. If they're going to really ramp up sanctions and make it more difficult to get the oil and continue to have lockdowns, very likely this goes higher. Alternatively, this could drop quite quickly if there's some sort of resolution. And here's a longer term look at oil just to see that almost impossible to keep prices this elevated without creating a financial crisis. Now, the second the conflict ends, I'd actually like to go long an ETF FNGU, and that is really shaping up to be a heck of a return. You know, this could be another 200 to 300% return like we had on BOIL. But just think about it. Tech companies need the supply chains to get fixed in China, and they need the neon from Russia and Ukraine to flow to the semiconductor companies to create all the chips. So until those two things occur, the pain for tech could continue, as well as the bond market. So this is really getting more painful by the second for these tech giants. So we're holding off on F&G until more criteria are met to make it a safer trade. The last time the US tightened while China expanded credit, and throw in Japan here, it's important to know we had a really nice return in cryptocurrencies. Bitcoin actually went up 4,400%. Now, what's critical to note is after this, the price fell from 20,000 to 3,000, and it was driven by quantitative tightening, which we've now begun. But in my opinion, what's more important is to predict the future price of interest rates. And so if we think interest rates have peaked out, this could be a very, very good time to be getting bullish in cryptocurrencies. So it's critical you watch our webinar every Monday, Wednesday, Friday. We've typically been doing my webinars Monday and Friday, so I have more research time over the middle of the week. But if there's anything ever extremely important, we will throw a Wednesday webinar. And Dean's been hosting a free trial webinar on Wednesdays just to help people get built out. So keep a lookout for your trade alert and call Dean now at 505-322-7515 to upgrade your free trial. All right, we're going to hit the topical news feed, which is always fun. And then we'll go into charts and data. And I'm looking at the feed. A lot of people are wondering, so is everything going to crash until the war ends? Yeah, well, I don't think the world can handle the war going on forever here. And now the prices are stabilizing in energy. And people are, Russia's finding new orders, new customers to sell their oil to. So the whole shock to the system seems to be getting behind us. So yeah, I'm not recommending you sell your stocks or your cryptocurrencies, despite the war probably going on longer. But that's the catalyst that would make me want to get into FNGU would be the war coming to an end. Now, think about it, Bitcoin and Ethereum don't use supply chains coming through China. So it's really the tech giants who need chips and need the manufacturing sector of China to operate that we're more concerned about. All right, so let's take a look at this. This is the 60-40 portfolio, very famous strategy. One of the worst declines ever for this combination. But what usually comes after that is a great return. So I think we're very near the end of the pain, and a stock crypto bond portfolio should do really, really well very, very soon. So I keep saying that. We keep seeing more and more volatility. So we'll see how long it takes. Okay, this guy said, Holger says, ouch, billions in wrong way ETF bets placed just before the Thursday, Friday route. 600 million was plowed into ARK, 426 into the Triple Q, a product that delivers 3 times the return of the NASDAQ. Consumer credit jumps to $52 billion in the latest update, expected at 25. So consumers still strong. I'm not predicting a huge crash anytime soon. All the data is quite strong. Okay, Alf says, if you were wondering how special the Wednesday and Thursday stock market volatility was, only 8 other times since 1970 had the S&P 500 recorded such large daily returns. So very, very rare moves we're seeing in all these assets. US 10-year yield has now doubled year to date, contributing greatly to a dollar strength. But again, do we think yields are just going to keep going up, or are they going to reverse? And that's exactly what we think. We're very close to a reversal in interest rates. Hungary says a oil ban would be like dropping an atomic bomb on Hungary's economy. $3 million moves the ES 1 tick. This is a market for ants, and there's very low liquidity right now, which is good and bad news. It means the market can go up or down with very little trading volume. We looked at that correlation chart already. Here's the interest rates on the 30-year going to an extreme level. And again, when they go to these extreme levels, typically they peak, feels like it takes forever, and then they crash. And that's what we're anticipating. Peter Zahan says the Ukrainian military has enjoyed an outsized amount of success when it comes to successfully finding and eliminating a variety of high-value Russian targets, which means they're probably getting some help. And the U.S. actually took credit for that big warship that was sunk recently. Now, while we did have a good jump in jobs, the labor force participation rate did fall in this most recent update. We'll look at that in more detail. And this is a thread. This guy's a smart guy, very bearish all the time, has a big thread about the decline of Japan, and goes through comparing that to China in terms of what happens if you just print endless amounts of money to do construction projects that are not productive to the economy, which is what China does very aggressively to keep everybody busy and to hit their GDP targets. So if you want to read that in more detail, right here on my Twitter thread. But a lot of similarities, except China has this massive manufacturing sector, whereas Japan really did not have the same setup. Okay, this is from Raoul Paul and Real Vision. It says Ethereum's proof of stake yield will become the risk-free rate of the internet, which is a pretty cool idea. US unemployment rate remains at 3.6%, the lowest level since the start of the pandemic, and only 0.1% above the 50-year low we saw in February. But remember, the labor force participation rate did fall a bit. So interesting data on the labor front. Russia and China control most of the faith of the global supply chain, and in turn, the degree of hawkishness the Fed will have to apply going forward, which in turn means Russia and China have a strong say on where the equity market is heading to. Not exactly reassuring. 19 bear markets past 140 years, average price decline 37%, duration 289 days. Past performance, no guide to future performance, but if it were, today's market ends October 19th, 22 with S&P 500 at 3,000 and the NASDAQ at 10,000. Bank of America. Rick Ryder has a big thread on the jobs report. Today's jobs report was another interesting read into an extraordinarily tight labor market. A whole series of conditions, including the rapid reopening of the economy post-COVID, immense monetary and fiscal stimulus leading to very rapid growth and sizable retirements, have placed labor markets in a condition that just might be the greatest mismatch of demand versus availability for labor in history. Turning to the data, total non-farm payroll saw a gain of 428,000 jobs last month, bringing the 3-month moving average for non-farm payroll gains to 523,000 jobs. The headline figure today was modestly greater than economists' consensus, estimating 380,000 jobs. Between these retirements and a rapidly growing economy, we're witnessing an extraordinary period of scarcity of available labor, which in turn is driving wage inflation to extremely high levels, as seen by today's average hourly earnings data of 0.3 month over month and 5.46% year over year. Yet, despite the strong conditions depicted by today's report, there also appears to be some modest slack now building in labor markets. Indeed, we're seeing multiple surveys showing companies' ability to hire becoming easier, and the areas most widely struggling to find labor, such as restaurants and hospitality, describing a greater ability to hire. More broadly, we think that the economy is moderating in a number of places. In many earnings reports, companies have been describing a more uncertain outlook and slowing labor demand, such as Amazon this week. The impact of dramatically higher recent interest rates is also dulling companies' outlook on financing and growth from here. Thus, our sense is that labor demand might be peaking, ironically, at the same time the Fed is accelerating its rate hike and balance sheet reduction process. Moreover, financial conditions are tightening in amazingly rapid fashion, and while economic conditions more broadly take longer to react, we think that we will see some more evidence of this slowing over the coming months. How labor markets moderate from here will be a focus for the Federal Reserve, which is moving headlong in its attempt at bringing down inflation. We think that inflation will move down somewhat as the Fed desires, but also think unemployment will likely move lower too. That raises the question of whether the Fed may slow its tightening process at some point over the coming months as a result of these expected trends. But while that's possible, recent data won't provide markets much comfort of that happening anytime soon. Big news in auto, the Manheim used car index just recorded its largest 90-day decline in history, falling 6.6% since January. The longest duration bond ETF is now down over 41% from its high, more than 3 times the current drawdown of the S&P 500. Zeros. Okay, here's a look at commodity price changes over the last year, and we nailed it being long natural gas, but you can see the cost of hard goods are going up rapidly, except we got lumber falling in this time frame, which is another signal that perhaps lower costs are coming through. Natural gas price rise to the highest level since 2008, increasing 186% over the last year. So how high could it go? Well, if we go back to that 2008 crisis, wow, it went all the way up to, I believe that's like 13. So if this becomes a war strategy to cut off Europe from natural gas, this could go up much, much more. So dangerous play. It's at a very high level, and it's going to be catalyst driven with catalysts that are very hard to predict. Okay, Michael says, I'm going long US Treasuries. No way the Fed raises another 10 times. US rents hit another new high in April, up 16% over the last year. So there's some sticky inflation coming in, trying to catch up with the rise in housing prices. A truly historic event in the stock market. Only 8 other times since 1970 has S&P 500 swung as much as it did in the last 2 days. All unleashed by Powell ruling out a 75 basis point rate hike yesterday prematurely in the release of unfriendly unit labor costs this morning. I see only one exit from this war. Russian forces fall back into Donetsk and Luhansk regions as per USSR oblast boundaries. Both sides accept plebiscites supervised by neutral powers as the solution, whereupon ceasefires come into effect and all war sanctions are lifted. So that news would certainly make something like natural gas fall rapidly, and perhaps also oil. So we got to be careful. Free trial guest says, are we buying anything today? Yeah, so everything but Boyle is game on for the trading plan. We'll consider Boyle or any other buy next week. So you have that part of the portfolio is in cash. Longview says some rates, PM is blowing up today. I was looking for rumors of dead bodies. That's what they say with people getting margin calls, but so far it's really not quite clear who blew up Thursday when the bond market opened so much lower, way below critical levels. Okay, so S&P 500 is down 13% in the first 86 trading days of 2022, the fourth worst start to a year in history. This is looking at the return after such a crash. So about half the instances, you have some really huge returns shortly after, and about half the other time, further declines. So interesting on that front. Let's look at the bond market's return here, just vicious. If the year ended today, it would be the worst in history for the US bond market with a loss of 10%. Entering the year, the 2.9% decline for bonds in 1994 was the largest ever. Now, so this looks at the return of bonds with an aggregate portfolio, and you can see it almost always goes up. And that's mainly because the way debt grows is interest rates fall over time. And so this is historical, but keep in mind, this is the total return for the complete year. It's not telling you what kind of drawdowns there were intra-year. So, yeah, will we actually end the year negative for bonds, or is it about to have a heroic comeback? Okay, very good. I think that covers the most important news. Okay, great. So let's go ahead and okay, so here is the rates over 30 years. And or excuse me, 30 years. I think that's about as far as it goes back. We can go back a little further. So 1980 is really where we had peak interest rates, and we've been in a bond bull market since then. So this is how they grow the debt. Interest rates go lower. The central bankers are trying to design a strategy to take interest rates negative. So there's some big papers out on how they want to do this. Essentially, they want to create digital currencies that essentially lose value if you don't spend them, and that's going to be their strategy to take the debt much larger and to also take these interest rates to negative territory. So this could be a really, really beautiful setup for bonds coming up here. And again, the key catalyst will be reopen the supply chains and get these energy costs down. So here's TLT, another look at it. And again, this is just a massive, massive move. Nothing like this in history. And we are recommending to buy the dip with TMF. Same thing in mortgage rates. You can see the trend. So we're very likely at the peak in interest rates any day now, and should expect these interest rates to fall. So we like treasuries, we like bonds, and we like the growth sector. And we would be betting that products like NRGU and BOIL will fall, as products like ETHE or the triple Q would go up, as well as TMF. Now I switched this from the 2-year and 10-year, which did invert and has begun to steepen, and I flipped it out with perhaps a more accurate 3-month over 10-year spread. So we can see the 3-month over 10-year has not inverted. The 2 over 10 has. So this is used to predict recessions. But again, after it inverts, typically you got 12 to 24 months before that recession sinks in and you get the stock market volatility. In general, right when it inverts, leads to a very big melt up in equities. Here's a look at the yield curve. So you can see the 3-month has just stayed stubbornly way down here. We've seen the inversions happening up here on the longer end of the bond market. Okay, here's a look at the VIX futures term structure. And we can see the forward price of VIX futures are above the months into the future. And this has been making the value of UVXY go up. Now, again, quite likely, very soon, the VIX is going to get shorted and crushed down and drive trillions of dollars into equities. And also, bonds are becoming very attractive. So I'm actually expecting we're going to see bonds and stocks go up in the near future, and that the VIX will fall. But again, we are patient and very loaded up. Safe Growth has a huge VIX position, and the high risk has a decent one. And we'll take a look at that when we get to that portion of the portfolio update. Reverse repo, $1.8 trillion. This has just been sitting here. It's a lot of money that could be coming into the financial system and potentially very bullish for the markets when it does go find a new home. This is the gold silver ratio, and this is predicting lower rates. So we've got copper falling while gold is staying up. So this would be indicating lower interest rates ahead. This chart, we're comparing our 2 favorite inflation interest rate hedges, BOIL, betting on natural gas, and then NRGU, betting on the top 10 US oil and gas companies. Both have done phenomenal. Since we pulled the trigger, though, BOIL has greatly outperformed. When we switched over from NRGU to BOIL, we'll pull back here. It's a dangerous play. It's a dangerous play. It's made us a lot of money. We might get back into it. But again, it's with a very balanced portfolio. If BOIL were to fall, your ETHE and your TMF would go up. Okay, another indicator that perhaps we're heading towards deflation, lumber. Uh, we've got all sorts of housing data slowing down. But furthermore, the lumber futures are falling. And again, last summer, this did predict a pullback in oil prices several months early. So perhaps that is right around the corner. Okay, here's DXY, the dollar. It's getting driven higher. It's making the value of cryptocurrencies denominated in the dollar look very weak. So do we think the dollar is just going to keep rising? We can see in the .com bust, it went all the way up to the 120 level, only to turn around and crash to 72, where you had a massive return in emerging markets outperforming the US stock market. We'll take a look at that chart. Jeffrey Gundlach, one of my favorite to listen to, manages over $150 billion in assets, believes we're very close to peak dollar and a great entry into emerging markets. So we could very likely be very close to that. And also, when the dollar falls, expect your cryptocurrencies to go up in value rapidly. Here's the yen and the yuan, the Japanese and Chinese currency. Just showing you the money printing is underway. They are bailing out their economies. We're seeing this in the weakness of their currencies. Okay, here's our 3 favorite cryptocurrencies, which have been in a painful move since December. So we've had, or actually since November, actually. Now it's interesting, Polygon actually did rise longer than Bitcoin and Ethereum. And our safe growth strategy, we're very bullish in Bitcoin long term. In our high risk strategy, we're very bullish in Ethereum long term. And if you are a paid member and you want to get access to our private equity fund, which has a weekly dividend and a leveraged bet on crypto, we have a very large position in Polygon, which has been painful since December. But if we're correct, the dollar's topping and yields are peaking. We could be on the verge of the next big move up. And I do want to point out last year, we had a similar interest rate problem that created some volatility. So I'll pull that up in a minute. Okay, now this chart, we are watching Ethereum against silver, seeing if there's some sort of uncorrelated way to play these to reduce volatility. And so far, nothing too impressive here. For some periods of time, we can see an inverse relationship, which is what we would want. So really, over this period, you can kind of see it until this recent leg down. So far, we've not pulled the trigger on going long silver or gold. Now, this chart was a little worrisome. We had interest rates rising in yellow, but the energy companies were falling and banks. We would expect both the banks in this pink line, FAS, and that the energy companies in green to be going up if the yellow line was rising, and only for the candlestick, the NASDAQ, to go down. So this rate of change of interest rates has been creating all sorts of volatility across all asset classes. But it is somewhat reassuring to see at least the energy companies going back up, not predicting demand destruction at these current energy prices. However, the banks falling with rates rising is troubling, and keeping a close eye on that at this point in time. Perhaps one of the more worrisome correlations that have broken down. Okay, so here's your emerging markets play from the .com all the way up to from the .com bust leading into the 2008 financial crisis. And you can see this extreme out return. There's huge pieces out by Ray Dalio explaining why emerging markets has a great setup, and lots of content from Jeffrey Gundlach explaining why a weak dollar he's very certain on over the course of time. Again, most likely the catalyst will be energy costs falling, interest rates falling, and some sort of diplomacy happening in Russia, Ukraine, NATO. In this chart, we're looking at some tech giants in emerging markets, specifically Alibaba in green, Tencent in purple, and Taiwan Semiconductor in the candlestick chart. And so we had some interesting news feed that the Premier Liu of China was talking to the tech companies. They're going to stop over regulating them. But they keep saying this and they keep punishing these corporations. So we're looking at these uh, all-star companies for signs that they're going to try to pump their stock market up and stop regulating their tech giants. Here's the European index. So again, with the safe growth strategy, the primary risk management thesis is to have a highly diversified portfolio. So this is the European index that we have a small position in. Try to make a beautiful rebound in March and gave it all back up. Jeffrey Gundlach remains very bullish on Europe and says he's getting ready to pile into emerging markets. So again, we still remain long Europe. This chart, we're looking at some alternative inflation hedges. So typically either BOIL or NRGU is to protect us against the bond market crashing and core energy costs going up that affect the global economy. For tech companies, we're specifically long rare earth metals RAMX because they produce the lithium and cobalt needed for batteries. And the 3-year outlook for RAMX is beautiful when we look at the growth of electric cars and the demand coming in for lithium and cobalt. So we remain very bullish on rare earth metals long-term. REMX, we've got a small uranium play, which I'm thinking about swapping out in the next trade alert for safe growth. And then we're not in copper miners because we believe it's just a less volatile version of rare earth metals in terms of how it fits into the portfolio. But shortages for copper coming in as well. This is comparing gold to silver, looking for a potential diversion to hop into silver. Tempted to sell the uranium play for AGQ and the safe growth strategy. But it looks like we have very strong labor coming in. So I'm not so sure we're going to have this stagflation coming in anytime soon, or a dying economy. We just keep hitting new and new highs in consumer spending for the US. And we just had a record trade deficit yesterday too, hitting $100 billion trade deficit. Okay, core inflation likely has peaked. I believe this will start to fall. It needs to fall pretty fast to appease the bond market and equity markets. If inflation falls, we could be entering a Goldilocks situation that's beautiful for stocks. And again, the catalyst will be get those dang energy costs down. Here's the non-farm payroll print. So the jobs keep coming in here. The labor force participation rate did fall. So a little bit of a mixed read on the labor front. Banks had the biggest jump in credit month over month since the lockdowns. Consumer, I think, borrowed 52 billion was the new print that came in today. It hasn't updated on this page yet. Let's see if I. Yep, there it is, 52 billion. This perhaps is what pissed off the market yesterday. Maybe, maybe not. But the hourly earnings jumping 0.3, and it's been just printing these wage growths. So rent, energy, food, and wages are going to be some sticky portions of the CPI. But again, if we really look at the way that works, it's the rate of change. So as long as the energy costs stop rising and can just fall, in general, I'm expecting CPI to fall from here, and to give the Federal Reserve what it needs to slow down this hawkish talk as we head into midterms this winter. Here's consumer spending hitting a new fresh high. There's your balance of trade hitting $110 billion deficit. This is what Jeffrey Gundlach uses to predict the weakness of the dollar. The twin deficits continue to grow. So with that said, we did have record tax receipts due to all this strong spending recently. But we're still running a massive, massive multi-trillion-dollar deficit. And there's probably no looking back. Okay, so we did have a big slowdown in housing sales, but big picture, still in an upward trend and very strong. China's PMI went really low, and wow, look what happens when you lock down half the country. This is a new print just in, just remarkably low. They're going to have to print a lot of money to keep things trucking along there. And this reminds me of that 2016 to 2018 period where they nearly collapsed their real estate market in 2015. So very similar setup. Their exports and imports are rising. They had a huge slowdown in February, and now it's starting to pick back up to very healthy levels. So here's the Federal Reserve's balance sheet. So there's two bullish surprises on Wednesday. One was the QT was going to be slow and gradual to ramp up to 95 billion over 3 months. And then they said there's no chance of 75 basis point rate hike. So we get this huge melt up in markets. And then Thursday gave it all back. So some just really wild moves. But let's look at 2016 to 2018. That was where we did rate hikes, but not QT. Interest rates didn't peak till we did the quantitative tightening. So again, I think that's really the big thing to predict here. Interest rates going to keep going up, or are they going to fall? And that's how we need to allocate capital. And as you know, I think they are most likely to fall and not go higher, which sounds like a broken record at this point. With the TLT closing at 113.67. If you told me that we were going to have a TLT crash to 113 last October, I would have called you crazy, but here we are. So we need to be a little patient and see how this plays out here. Okay, good. So we're about to go into exact asset allocation. And if you're on a free trial, this is where your video ends. You need to call Dean. Take advantage of special pricing and upgrade at 505-322-7515. That way you don't miss out on the next trade alert. Okay, so let's take a look at our report card. Safe growth is down 10% year to date. Now, I'm happy with that. The strategy for safe growth is to have a highly diversified portfolio. And it has that. Everything has been crashing this year. We're using triple leveraged ETFs. So to be outperforming the S&P 500 with triple leveraged products is really quite remarkable. So we've primarily been able to do that with BOIL and with UVXY. That's really what's helped us out here. If I'm correct and yields are about to fall and stocks are about to jump, this can get back to positive territory in very short order. And we're heading into midterms. So do the Democrats really want a complete stock market crash leading into midterms to fight inflation? So, and what's the CPI going to do? We believe it's peaking and going to fall. And perhaps we're going to get some resolution and exhaustion from the war in the next 4 weeks or so. Okay, here's the high risk portfolio, just cleaning house, up 45% year to date. Almost all the profit has been on a massive bet on BOIL. It's been volatile, it's been scary, it's been, and it's paid off. So that's been the big money. I believe the rest of the year, the exact opposite's where we're going to make the money. So for me, the potential to make more money on BOIL is most likely in May and June only, and that's absolutely the exhaustion point for the economies of the world to deal with this hyper expensive energy and food cost. So my expectation is we potentially get a blow off top on BOIL and then sell it, but we will pay close attention to how to make that move next week. So I don't want to make any promises on that front. Now we recommend doing the 70-30 combo. I do need to update this return. We were sitting on a nice gain in the safe growth, and then it did go negative. So this is, will have to be updated. I'll do that for the next update. Okay, so we're in the risk calculator now. The safe growth strategy has a lot of UVXY, and at 16%, quite likely we will reduce that next week when we do the BOIL, when we replace what we had with BOIL into a new position, which could be simply going right back into BOIL. Going to be listening to the parade they're supposedly doing I believe, in Maripol on Monday to show off how well they're doing in the war, which, depending on who you listen to, you can get two totally different views of how the war is going. So let's listen to the news feed and get an idea of where the war is headed to make the trade alert for next week. But right now, our Boyle position, which was 17% of the portfolio, is cashed out and in cash. I would like to reduce UVXY to the 8 to 10% range, and I'm considering selling uranium for something else as well. So stay tuned for trade alerts next week. High risk portfolio dumped the 38% position in Boyle. High risk has a huge cash position, and we'll make decisions. UVXY at 11%, not bad. Probably won't touch that. But what to do with that huge cash position that was about 40% of the portfolio? Will we go back to Boyle? Will we do something else? That is to be determined next week based on what direction it seems the war is headed. And again, that's going to be very, very influential catalyst for interest rates, energy costs, food costs, supply chains, and all that. Okay, so let's go ahead and take a look. Ed every week wants to know, when the hell is EDC going to go up? As soon as energy costs go down, I would expect EDC to do really well. Okay, Michael says, nice trades on Boyle and NRGU since joining. I do manage my own trades as an active trader investor. I've made more money using your analysis over just using technical analysis alone. Well, that's great to hear. Thank you. Kathleen says, GBTC moving to an ETF. Will this help? Yeah, that would help reduce the discount on the assets of the trust. I'm not sure exactly how the mechanics work. But the way it is now, the trust version of GBTC has tended to have either a premium or a discount relative to the assets it holds. And it's been in both directions, good and bad. Supposedly with the ETF, they'll be able to buy and sell their shares and keep that discount at zero and highly accurate. Okay, let's see. Michael says EU has announced it wants to completely out Russian oil and gas. They want to. The question is, can they? They have already accomplished a 30% replacement of Russian sources. Pace of transition constrained by LNG ships and terminals. Your investment ideas should assume this is long-term, if not permanent. That's what I'm afraid of, Mike. I'm very afraid that you're right on that one. And why we've done so well with Boyle and NRGU. Stephen says, what if the war is just a way for the oligarchs to squeeze everyone and make them pay prices over the moon for energy that they can't live without? What if the war is as simple as that? What can't that situation last for another year or more? Yeah, all valid points. We will see. It's a lot of pain happening globally due to this. And you're seeing the oligarchs you speak of, the valuations of their companies are getting decimated due to this. Okay, Stephen says, will cryptocurrencies continue to crash as long as the Russian-Ukrainian war lasts? Well, I think there's more details to that. I think the reality is, if energy costs go up at a fast rate of change, then it's going to be negative to the bond market and thus cryptocurrencies. If the war just kind of teeters around here and Russia slowly finds new places to sell its oil, production increases now that there's more profitability. So I'm not necessarily thinking that even with a elongated war, that the bond market's going to keep crashing. It would really be specifically if the price of oil were to break into a new high, which was recently at what, 124, crawling back up today at 112. That's what I think would be problematic. So if the energy costs go up, not just stay here, likely to be very negative to the bond market and then tech market. Kathleen says with the cash position from Boyle. So yeah, right now what I'm recommending you do, let's just pretend we're doing it. Let's say you wanted to do 10,000 in high risk. What I'm recommending you do is keep the Boyle position in cash. So right now you'd have 3908 in cash. You'd have 3222 in Ethereum, 1723 in treasuries, TMF 1147. The product or the software I developed, unfortunately, doesn't have a dollar position. That's just the dollar. We could do EUO, which would be betting on the dollar versus the euro, which is not a bad play. But we might be getting right back into Boyle. So I just left it on there, and I'm simply indicating to keep that portion of the portfolio in cash and patiently wait till next week to potentially put that cash to work. And I will work on upgrading it so I can just show, hey, this is the cash position. Unfortunately, right now, if I wanted to put you in the dollar with our software, it wouldn't just be the dollar. It'd actually be a Forex trade betting the dollar would go up against the euro, which again is not the worst trade in the world. But for now, again, we're telling you to sell Boyle and keep that as cash and wait for the next trade alert, which will likely be Monday or Tuesday. Okay, we got Tom Sharp saying, any comments on the SEC and FINRA looking at restricting the common investor from buying ProShare type leveraged products? So ProShare is sending out letters to all the shareholders to go complain because they are talking about taking those away. Yeah, if that happens, we would have to replace just about everything in the portfolio. So UVXY, there would not be an easy replacement. We might have to start teaching investors how to buy put options and roll them over every week, which is fine, but a big pain in the butt. TMF would be replaced with TLT. ETHE should be fine. Boyle could disappear. At this point, it's all not clear whether or not that'll really happen. So UPRO would change to SPY, EDC would change to EEM, EFO would change to EFA. REMX would not be affected. GBTC would not be affected. Boyle could disappear. We will see. Triple Q would switch to the QQQ. NRGU would be replaced. I'd have to find the most similar one, but it'd be a oil and gas ETF that's non-leveraged, and uranium would not be affected. So yeah, there's replacements. But we like the leverage products with the highly diversified portfolio with risk parity. So hopefully that doesn't actually happen. Watching that news feed. Eddie says, is there any hope for the triple Q next week? Yeah, I believe that unless energy prices are shocked next week, we should very likely have interest rates topping out in a reversal of everything that's happened. So I'm expecting Boyle and NRGU to go down and the triple Q, ETHE, and TMF to go up. And that's going to be the big trade. So the exact opposite. So we just made out like a bandit for the first half of the year, betting on inflation and energy costs going up. And we hedged it with ETHE, with the NASDAQ. Now, I believe the bet is the exact opposite, that everything's going to unwind in the exact opposite direction. And that we're very close to that. And the catalyst is going to be these energy costs stabilizing or falling. Not necessarily saying they have to crash for this to play out, but they have to stop rising rapidly. The rate of change of energy going up is blowing out investors and causing pain in markets. So that's the way we're looking at markets. See, Steven says it stands to reason the super rich want to keep everything good to themselves and keep the peasants out of these investments. Do you agree? Sure. Yep. Let's see, someone says, and when do we pair positive positions? So yeah, right now you would build out the whole portfolio and leave the Boyle in cash. Because I think we might maybe get a better price next week if we go back to Boyle. Again, I guess there's going to be a parade, I believe, in Murray Pool to brag about Russia's success, and then we should potentially get a gleam of what their intentions are, whether it's to fortify and de-escalate and get their economy rolling, or if it's going to be more aggressive. Also, we need to see what really Germany and France are going to do. They're the ones that could escalate or de-escalate the sanctions. From Europe's side, from the U.S. side, they just sent out Nancy Pelosi. They're putting out these, we're in it to win it sort of things. Zelensky seems to be pitching that he can go take back all the lost territory. So yeah, a lot of moving factors, hard to predict. I obviously miscalculated the length of the war. Luckily, to hedge that risk of me miscalculating the war, we had a huge oil position that's saved our butt this year. So funny to have that prediction completely wrong. And luckily, because we knew of the risk, we did very well with oil. Rock says, if not Boyle, what other possibilities do you see? I like FNGU. I like TMF. I like MOS. MOS is a fertilizer company in the US. So if energy costs just stabilize at these higher levels, MOS could do very well. MOS. That's really what I'm contemplating as far as a big position. Boyle, NRGU. I don't like NRGU. It's back to a new high. Now that's where you hurt Russia's money, though, is trying to block. But India and China just don't care. And so I still think, yeah, if we're going to go back in an energy play with where prices stand today, NRG is back to a new high. So Boyle pulling back with a significant pullback, 15% decline today. Crash it some more. I'd love it. And then show me that the war is going to escalate and there's no intention on any of the three parties. So it's really NATO, one group. Then I would say Germany and France are not quite aligned with what the US wants. And then you got Russia as well as China. So very, very interesting development here. But yeah, so I like TMF a lot. I've been patient. That paid off to not go all in on treasuries. If that, I was telling you guys, if you go below 120 TLT, all hell's going to break loose. And perhaps it did Thursday. And we got TLT at 113.67. So I do like treasuries a lot. F&G looks attractive. And Boyle, if the war is going to continue, could go much higher. So that's what I'm kind of contemplating at this point. Okay, guys, so we will have a webinar Monday. Rebel Dividends is going to do a Tuesday webinar with a full update. I was sitting there just in case the bond market, again, went way below level I think is safe. So I was watching for a crisis to unfold and be ready to protect capital for Rebel Dividends. Quite impressed with Bitcoin, to be honest, with the bond market volatility. So looking good as long as the dollar comes down, interest rates fall. Extremely bullish on tech, crypto, and bonds. I think we're very, very close to that moment in time where the exact opposite that's worked for the last year, or at least the start of this year, is going to play out as the winning trade setup for the remainder of the year. Okay, beautiful. Well, thank you guys so much, and we'll see you back on Monday, same place, same time. Of course, we'll get the trade alerts out in the morning. If it's coming out late, that means I'm contemplating pulling the trigger on something. So just note, if it's a little bit slow to go out in the morning, that's because I might be pulling the trigger on something. Okay, beautiful. Thank you guys so much, and we'll see you back on Monday. Have a great weekend.